Hello everyone, let's start with the performance measurement and control section C question from Kaplan Kit. Let me read out these questions. Hammer is a large garden equipment supplier with retail stores throughout the tool land. So tool land is a place we need to see what is the nature of the business. So I can say that tool land is the uh, a tool land is a place where Hammer is actually conducting its operations, and the operation is of the business is of uh, supply of large garden equipment. Okay, large garden equipment supplier. So Hammer is a large garden equipment supplier, and it's supplying to the retail stores throughout a place called Toolland. Many of the products it sells are bought in from outside from the suppliers, but some are currently manufactured by Hammer's own manufacture division, Nail. So that means there is an internal transaction going in place, which is from Nail. So Nail is one of the division in Hammer, and some of the tools are being purchased from Nail. So okay, so this is a question of transfers within the division. The price of transfer, that the prices, that means the transfer price. Now when we say the transfer price, the price transfer price pertains to the price at which the internal transfer is going on between Nail and Hammer. So basically Hammer is the parent company. Hammer is the parent company, which is first we'll draw this chart. This is the parent or the head office, and this um, nail is the division. So the transfer is going from Nail to Hammer. Okay, but this transfer, the current policy is for Nail to calculate the total variable cost of production and delivery, and add 30% for profit. Nail argues that all the costs should be taken into consideration, offering to reduce markup on cost to 10%. In this case, the retail stores are unhappy with the current pricing policy, arguing that it results in prices that are often higher than comparable product available on the market. Nail has provided the information to enable a price comparison to be made of two possible pricing policies for one of its product. Garden shears. So Nail has provided information to enable its price comparison to be made with two possible pricing policy of one of its product. So Nail has provided some information. Okay, garden shears, steel. The shears have 0.4 kg of high quality steel in the final product, and the manufacturing process losses 5% of all steels, but uh, steel cost is 4,000 kg per ton. So the shears have 0.4 kg of high quality steel in the final product. So we need to see this is 0.4 kg of final product. That means steel shears have how much steel in them, 0.4 kg. The final product would have 0.4 kg of steel in it. That means the normal loss is taken into consideration, and then this 0.4 has been given. The manufacturing process loss is 5%, so we'll need to calculate the gross value of the steel used. This is the net value. Net means the gross minus the process loss, and then you're getting 0.4 kg. So we need to find the gross value of how much input of steel was there. Other material are bought in and have a list price of 3 per kg, although Hammer secures 10% volume discount on all the purchases. The shears require 0.1 kg of these materials. The labor time to produce shears is 0.25 hours per unit, and the labor cost 10 per hour. The variable overheads are absorbed at the rate of 150 of labor hour, and fixed overheads are 80% of variable. So fixed cost are 80% of the variable cost. How we had to calculate the transfer price? We only had to include the variable cost of production. So I believe the fixed overheads will not be included, but whatever the fixed overheads are, 80% okay, fixed costs are included, I'm sorry for that, but whatever fixed costs are there, how will you calculate? You will calculate the variable cost, and the 80% of the variable cost will be fixed overheads. So delivery is made by an outsourced distributor that charges nail 0.5. So there are sales and distribution, but these are in the case of external transfers, right? So okay, calculate the price that Nail would charge for the garden shears under the existing policy of variable cost plus price plus 30%. So let's solve the first part, and the first part is we'll have to calculate the variable costs, and the variable cost are first the information related to the variable cost. Main information is given over here. Steel. So if I talk about steel is the material which is used, and I told you that 0.4 kg is after the normal loss, so it's 0.4, and I'll convert it. Okay, so steel is 0.4 kg, and I would have to convert it into 100%. So for converting into 100%, I will divide it by 95, that is 100 minus 5%, and I will multiply by what? By 4000, because that is the that is the price per ton. So this is the price per ton. So tons are in 1000, and this is in kg, right? Tons are in 1000. If I want to convert tons into kg, what will I do? I'll divide 4000 by 1000, and I shall get 4. Okay, so I will multiply it by 4 over here, and I will get the cost of steel, which is 1.68. After that, other materials are being used. So other material, what is the cost of other material? Other materials are bought in and have a list price of 3 per kg. Although Hammer secures 10% of volume discounts on all the purchases, the shears have 0.1 kg of these material. So okay, so other material, I would say that shears, how much shears are using the other material, that is 0.1 kg, right? So what will I do? That is, other materials are bought in and have a list price of 3 per kg, although the hammers secure a 10% volume discount on all the purchases. So if hammer is availing, although hammer secures a 10% volume discount, so will that 10 will at what price we will include this other material for transfer pricing purpose? We will have to include the volume discount, because this is a kind of cost, and so while calculating the cost, we will include the other material by excluding the including the volume cost, because it's a cost that this volume cost is a cost for nail. That's why we will include this volume discount. So 3 kg and 100 minus 10% is 90%, so this is 0.9. And how much shears, how much this other material is required for manufacturing of shears, that is 0.1. No, not 0.1, yeah, 0.1 kg. Because when we read the question, we get to know that the main product which nail is transferring to the hammer, it's garden shears. Okay, so we need to calculate how much material is being used for manufacturing of shears, whether it's material steel or other material. And now the labor time to produce shears is 0.25 per unit, so I'll include this as it is. Labor, how many hours, is there any information about hours? Yeah, okay, so this is 0.25 hours per unit and the labor cost is 10. So labor cost would be 10 into 0.25. So 0.25 was the time being taken to manufacture shears by the labor, and what is the cost per hour? It is 10. So 10 into 2.25, it gives you 2.5. Okay, and then variable overheads. So variable overheads are 150% of labor rates. 150% of labor rate. What is the labor rate? It is 10, but you have calculated over here as 2.5. So it says that it is 150% of labor rate. Now 150% of labor rate is 0.25. No, not this. Sorry. Labor rate is 10 per hour, and I will multiply it by 150%. So this is labor rate is on hourly basis, so I'll have to multiply this by 0.25. So 10 into 150%, it gives you 15 into 0.25. So this is 3.75. After that, it is telling me that fixed overheads are 80% of the variable cost. But over here, this question says that it is total variable cost of production. It has specified. So we do not need to consider the fixed overheads. Now, it had asked me that there are some, it had said the delivery is made by an outsource. Okay, so over here I mentioned earlier that nail can charge this for selling and distribution, but as per the information, there are some materials which are used by nail, and these are outsourced. So delivery is made by an outsourced distributor. So whatever shears are made, they're transferred to hammer, but this transferring process is given to an outsourced distributor, which who charges nail for nail as 0.5 per garden shears for delivery. So delivery cost, it is 0.5 per garden shear, right? So number of garden shear we do not know. We are already calculating the cost as if it's cost per shear. So 1.68 plus 2.27, 2.5, we'll just add all of these, and it's giving me 8.7. So this is the total variable cost, and now I need to add 30% profit. How much will be the 30% profit? 8.7, 30% of it is 2.61. So I'll add 8.7. This is 11.31. So this is my transfer price. Okay, so first part is done. Now let's see what's the second part. The calculate the increase or decrease in the price if the pricing policy switch to total cost. Now it is saying total cost. So if it's asking me about total cost, that means I'll have to include the fixed cost as well. So my total variable cost, this is B part. My total variable cost was 8.7, and what are the fixed cost? The information about fixed cost was that fixed cost are, it was given 80% of variable cost. Yeah, fixed cost are 80% of the variable overheads. So 80% of variable overheads. Now what are my variable overheads? So I can see, so variable overheads were this, which we had calculated over here. These are variable overheads. So let me highlight this with some other highlighter. So these are my variable overheads. So this portion is really important for calculating the fixed cost. Okay, so in the question it is given that fixed costs are 80% of the variable overheads, and my variable overheads is 3.75, right? So 3.75 and 80% of it is 3. So 80% of so 80% of 3.75, 3.75 into 80%, it's 3. I'll add this to 8.7, it's 11.7, and then it's saying, as per the question, there's only 10% markup. So this is the total cost, and profit markup, is 10%. Okay, so calculate the increase or decrease in price. So we need to calculate the increase and decrease in price if we switch to total cost plus 10% policy. So this price gives me total cost. As per the total cost is 12.87 minus variable cost plus 30%. So this is just a minute, I'll rewrite it again. So what I mean to say is total cost plus 30% markup minus variable cost. No, this is not what am I writing? Sorry, this is 10% and this is 30%. Markup would give me extra cost. We'll have to write all these steps within in the exams, because we won't get marks. Each and every step has marks. So it's 12.87 minus 11.31, and therefore there is an increase in the price. I can see that there is an increase in the price if we follow the total cost plus 10% policy. So how much is the increase? Increase in cost by using total cost plus 10% policy would result in increase of price by $1.56. I'll write it clearly once again. Yeah. So now we have to discuss whether or not including fixed cost in a transfer price is a sensible. Okay, let's read it out. So I would say that as far as this is all discusses, so I'll just read it out. So as far as the manufacturer is concerned, including fixed costs in the transfer price will have the advantage of covering all the cost incurred. So in theory, this would generate a profit for division, uh, profit for the division. So in a sense, the manufacturer is reducing the risk in their division. So first of all, what is the advantage to the manufacturer? To the advantage to the manufacturer is that it reduces risk. Risk as in the cost includes entire or total cost. Okay, so this risk is mitigated. So the risk of division transferring services or goods gets reduced. Now for how much marks is this question? This question is for 4 marks, right? So we need to write at least 4 points. So 1. Second, it gives you a holistic picture as well, right? So the manufacturer is concerned by including fixed cost in transfer pricing will cover the entire cost. So in theory, it guarantees it also. So this policy would guarantee. This policy would guarantee profit to the division because the transfer price includes fixed cost and variable cost. And you can use the above example as well. If you are including the profit, you will earn more profit as well, right? Now what shall be the third point? But one of the major problem is that sometimes it is not see, variable costs are like based on per unit, right? But in case of fixed cost, it's not. So sometimes it gets difficult to include fixed cost, and it is very difficult to include fixed cost and divisional managers can manipulate the fixed cost. So one is the manipulation, and the fourth challenge, which is fourth challenge can be that the fixed cost are sorry fixed costs are fixed for manufacturers but variable for the purchaser. This leads to poor decision making. So, poor decision making, manipulation of fixed cost, manipulation of fixed cost, poor decision making, so advantages also are there, that this is disadvantage. Two disadvantages I have given, and I have given also the advantages. Okay, so we need to include, as per the C part, discuss whether or not, so advantages and disadvantages both needs to be included. So I gave two advantages, that it reduces the risk and also it guarantees the profits. It guarantee spelling, okay, so this is not the spelling. It guarantees profit. So two advantages and two disadvantages were mentioned. So what is the conclusion? Is there any conclusion? So there is no such conclusion. You can either start the question by the advantages and disadvantages. Basically it's asking the advantages and disadvantages, so you can just write the advantages and disadvantages of including the fixed cost are as follows, and we can assess whether the fixed cost will be included in the transfer price or not, based on the three factors mentioned below, and four factors mentioned below. And the four factors are these factors, which among which the two factors are advantages and other two are disadvantages. So this is quite subjective, so whatever it depends on the person to person who would choose the manager to manager who would choose the transfer price. So discuss whether the retail store should be allowed in to buy in from outside supplier if the prices are cheaper. Okay, so it's asking about like we should buy from outside or not. So there are several challenges when we buy from outside. The D part, we are doing D part. For D part, it's like first of all is the delivery, consistency in delivery. So consistency in delivery, because the delivery, the if we outsource this garden shears to an outside supplier, the delivery might not be consistent. It can deliver either if the delivery is scheduled for like monthly or weekly, and the vendor might not the vendor might not adhere to the delivery schedule. So there might be a delivery schedule decided amongst Hammer and the and the outside supplier. But the outside supplier, there is a risk that the the outside supplier would not follow the delivery schedule. So this is one point. Another point I feel is price stability, risk of price instability. See, there are external factors as well. There are external factors like technology or government policy or competition as well, which might affect the demand as well, demand and supply. Okay, so there are various factors which are non-financial factors. These are called non-financial factors. Non-financial factors. So they can be non-financial factors due to which price might increase. So the price might increase or decrease or increase. So this might impact your price. So the vendor, they can be risk of price instability. And for third can be a quality inconsistency. So there is a risk of quality okay. Right, so the vendor might choose cheaper raw material. Right, vendor might use cheaper raw material. Okay, and fourth can be, if all these factors are there, all these risk factors are there, the above three, so it might affect the public image of Hammer or impact its goodwill negatively. So these are the factors.